Hello students, in this video let's solve the remaining problems under debt equity ratio. Let's see the fourth problem of debt equity ratio. BS Limited had the following balance sheet as on 31st March 2020. The liabilities are share capital, under that equity shares 1 lakh, preference share 50,000, then reserve surplus, there is no reserve surplus. So equity shares, preference shares are the net worth, comes for the calculation of net worth. Secured loans, unsecured loans, these are the long-term debt. Current liabilities and provisions will not come for calculation of debt. So here on the asset side, fixed assets, investment, current assets, loans and advances. This is the loans and advances given. So if it is there on the liability side, we have to take, but loans and advances are there in the asset side, so we are not considering this. Then miscellaneous expenditure. So fictitious assets are preliminary expenses, discount on issue of shares and profit and loss account given here. So these are the fictitious assets from the shareholders fund, that is from the equity share capital, preference share. From these total we have to deduct all the miscellaneous expenditure. So if a profit and loss account appears on the assets liability side, then we have to add to the shareholder fund, but here it is appearing on the assets side, so we have to deduct this. So let's go for solution. Calculation of debt equity ratio. First let's calculate long-term debt. So here there are two long-term debts, that is secured loans and unsecured loans. So you have to add both. That is secured loan 1 lakh, unsecured loan 50,000. So total long-term debt is 1,50,000. Second, you have to calculate what is the total net worth. Net worth includes what? Equity shares, preference shares, reserves and surplus. From that you have to deduct fictitious assets. So first let's see which are the shareholders fund, that is equity share capital, preference share capital and reserves and surplus. So in this problem we have equity shares, preference shares and reserves and surplus nil. So shareholders fund includes only two items, that is equity shares and preference shares. So equity shares 1 lakh, preference shares 50,000. So total shareholders fund is 1,50,000. From that you have to deduct all the miscellaneous expenditure which is there on the asset side. So here miscellaneous expenditure, that is preliminary expenses, discount on issue of shares and profit and loss account. Profit and loss account asset side ಅಲ್ಲಿ ಇದ್ರೆ ಡಿಡಕ್ಟ್ ಮಾಡಬೇಕು, ಲಯಬಿಲಿಟಿ ಸೈಡ್ ಅಲ್ಲಿ ಇದ್ರೆ ಆಡ್ ಮಾಡಬೇಕು. ಯಾವುದಕ್ಕೆ? ಶೇರ್ಹೋಲ್ಡರ್ಸ್ ಫಂಡಿಗೆ. ಶೇರ್ಹೋಲ್ಡರ್ಸ್ ಫಂಡ್ ಇನ್ಕ್ಲೂಡ್ಸ್ ವಾಟ್? ಯಾವುದನ್ನು ಇನ್ಕ್ಲೂಡ್ ಆಗಿರ್ತದೆ? ಅದು ಈಕ್ವಿಟಿ ಶೇರ್ಸ್, ಪ್ರಿಫರೆನ್ಸ್ ಶೇರ್ಸ್ ಅಂಡ್ ರಿಸರ್ವ್ಸ್ ಅಂಡ್ ಸರ್ಪ್ಲಸ್. Got it? So now we need to deduct miscellaneous expenditure from the shareholder fund, from equity share and preference share total. So here miscellaneous expenditure, preliminary expenses 10,000, discount on issue of shares 20,000. We are getting this amount from the balance sheet. So profit and loss account 20,000. So total net worth is 1 lakh. So now we need to calculate debt equity ratio. So you can calculate debt equity ratio, debt equity mix. So if it is a ratio, this is a formula, like long term debt is to net worth. So ಒಂದು ವೇಳೆ debt equity mix ಅಂತ ಕೊಟ್ರೆ, so formula is long term debt divided by net worth. So here we have a total long term debt, that is 1,50,000, and total net worth is 1 lakh. So 1,50,000 is to 1 lakh. So here you can cancel. ಸೊ ಒಮ್ಮೆಲೆ ಕಟ್ ಮಾಡಲಿಕ್ಕೆ ಅಂದರೆ ಒಮ್ಮೆಲೆ ಆನ್ಸರ್ ಫೈಂಡ್ ಮಾಡಲಿಕ್ಕೆ ಕಷ್ಟ ಆಗ್ತದೆ ಅಂತ ಹೇಳಿದರೆ ಸಿಂಪಲ್ ನಂಬರಿಂದ ನೀವು ಡಿವೈಡ್ ಮಾಡ್ತಾ ಹೋಗುವಂಥದ್ದು, ವಿಚ್ ಆರ್ ಡಿವಿಸಿಬಲ್ ಫಾರ್ ಬೋತ್ ದ ಫಿಗರ್ಸ್. ಸೊ ಹಿಯರ್ ಐ ಆಮ್ ಕ್ಯಾನ್ಸಲಿಂಗ್ 4 zeros both the side. So here we are getting 15 and 10. So 5 2s are 10, 5 3s are 15. 5 2 10, 5 3 15. So ratio is 3:2. ಒಂದು ವೇಳೆ ಪ್ರಾಬ್ಲಮ್ ಅಲ್ಲಿ ಡೆಟ್ ಇಕ್ವಿಟಿ ಮಿಕ್ಸ್ ಅಂತ ಕೇಳಿದ್ರೆ, ಕ್ಯಾಲ್ಕುಲೇಟ್ ಡೆಟ್ ಇಕ್ವಿಟಿ ಮಿಕ್ಸ್, ದೆನ್ ಫಾರ್ಮುಲಾ ಇಸ್, ಸೊ ವಿ ಆಲ್ರೆಡಿ ಡಿಸ್ಕಸ್ಡ್ in a theory part. So formula for that is long term debt divided by net worth. So in a single figure you can calculate debt equity mix. So here total long term debt is 1,50,000 divided by total net worth is 1 lakh. So 5 2s are 5 3s. So here you'll get 3 by 2. If you simplify this, you'll get 1.5. 1.5. Debt equity mix anta kelidre, you have to write this formula, and by this way you, in a single figure, you need to calculate the debt equity mix. So here debt equity mix is 1.5. Next, problem number 5. Calculate debt equity ratio of ACL Limited for the years 2010 and 11. Comment on the variations of debt equity ratio, if any, from the year 2010 to 2011. So here only liabilities are given of 2010 and 2011, and we are nothing to do with the assets. So we need only liabilities to calculate debt equity mix or debt equity ratio. So sundry creditors, bills payable, debentures, long-term loans, reserves and surplus, profit and loss account, equity share. Asset side alli namage bekagiro item yavadu anta helidre miscellaneous expenditure. So we are deducting from the shareholders fund. No other than that, remaining components on the asset side is not necessary for calculation of debt equity ratio. But here only liability side and the matra kottidare anta helidre, you can see there is no fictitious assets. That means there is no item to deduct from the shareholders fund. So sundry creditors, it's a current liability. Bills payable is a current liability. Here debentures, which will come for the calculation of long term loans. So this is short term, no, short term in nature. Long term loans or long term debts only we have to consider. So 15% debenture, long term loans will come for the calculation of debt. Reserves, profit and loss account, equity share capital. So only one kind of share capital is there, that is equity share capital and reserves. And here profit and loss account is there on the liability side. So here it is given a credit balance. That means we need to add to the equity share capital and reserves. Got it? Let's go for this problem. First, for the year 2010. So there are only two long-term debts. So that is 15% debentures and long-term loans. So we took a total of the two, 9 lakh and 6 lakhs. This is the information of 2010. So total 15 lakhs. So on 2010, 15% is debenture, that is 9 lakh, long-term loan 6 lakh. Total 15 lakh is a long-term debt. Then coming to net worth, here equity share capital 3 lakh, reserves and surplus 8,200, and profit and loss account 1,19,800. You need to take a total of that 3. Okay, that is 5 lakh. So they have asked to calculate a long-term debt equity ratio. So formula is debt equity ratio is to net worth. So 15 lakh is to 5 lakh. So 5 ones are 5 3s are. So 3:1 is a debt equity ratio. Then for 2011, same way, the information given in 2011 column you have to write. Two kind of long-term debts are there, 15% debentures and long-term loans. So here debenture is 6 lakh, long-term loan is 8 lakh, so total 14 lakh is a long-term debt. So it is 14 lakh. Then net worth, equity share capital, reserves and surplus, profit and loss account, only 3 items. Equity share capital 4 lakh, reserves and surplus 1,17,500, and profit and loss account we are adding, so it is 1,82,500. Therefore total net worth for the year 2011 is 7 lakh. So debt equity ratio is equals to long term debt is to net worth. So long term debt is 14 lakh and net worth is 7 lakh. So 7 ones are 7 twos. 7 ones are 7, 7 twos are 14. So debt equity ratio is 2:1. So in this problem they have asked to comment on this. So in 2010 the debt equity ratio is 3:1. In 2010 debt equity ratio is 3:1. So in a single figure if you want to calculate, so it is 3/1. That means it is 3. And in 2011 in a ratio it is 2:1. In a single figure if you want this 2/1, that means 2. So debt equity ratio has come down from 3 to 2. In previous it was 3, now it is in 2011 it is 2. So this is due to the reduction of 15% debentures from 9 lakh to 6 lakh. You can see in 2010 debenture was 9 lakh and in 2011 it is reduced to 6 lakh. Even if there is a changes, that means increase in long-term loans from 6 lakh to 8 lakh, but because of the changes which is made in debenture, the risk profile that has brought down. The increase in all components of equity has contributed it. The company's risk profile has improved from 10 to 11 because debt equity mix that was 3, now it is reduced to 2. That means risk profile has improved. Got it? That means risk from the investment that is reduced. So here we are solving the last problem in debt equity ratio. S Limited presents to you the following balance sheet is on 31st December 2019. So on the liability side is the equity share capital, reserves and surplus and preference share capital. So these three are shareholders fund comes for the calculation of net worth. Debentures. So this comes for what? Long-term debt calculation. Creditors, it is a current liability, it is not a debt. So profit and loss account, it is a debit balance, it is a credit balance which is there on the liability side. So we are going to add to the shareholders fund. Then there is one more adjustment. The directors intended to transfer a sum of rupees 50,000 out of profits to provision for tax. You are required to calculate the debt equity ratio. So here out of the profits we need to deduct 50,000, or from we need to add, we are adding profit and loss account to the shareholders fund now. So later at last we can deduct this 50,000 from the shareholders fund, or you can deduct this 50,000 from the profit, that means from the profit and loss account you can deduct while calculating net worth. So let's go for this problem. So there is only one debt, it is 6% debentures. So calculation of debt equity ratio, debt equity, long-term debt, 6% debentures, there is only one item, so it is 2 lakh. Then net worth calculation, equity share capital 5 lakh, preference share capital that is 1 lakh, reserves 4 lakh, and profit and loss account 2,10,000. So total is 12,10,000 less a proposed transfer. So directors, they are intended to transfer sum of rupees 50,000 out of profit. So we are deducting here, that is 50,000, or you can deduct it from the profit. It will not make any difference. You can deduct from the profit, or directly you can deduct from the shareholders fund. The less fictitious asset. There is one more fictitious asset. There is one fictitious asset, that is preliminary expense. Preliminary expense, it is 80,000 we are deducting. So total net worth is 10,80,000. So debt equity ratio, long term debt is to net worth. So long term debt is 2 lakh and net worth is 10,80,000. So it is 10:54. So how you got that? 2 lakh is to 10,80,000. So here we are cancelling 4 zeros first. Then you can divide it by number 2. So 2 tens are 2 5s are 10, 2 4s are 8. So you can simplify even more, that is 2 2s are 2, then 1 remains here, so 2 7s are 14, then 2 5s are. So 5 is to 27, or you can write 10 is to 50.